In 2024, the United States government spent more money on interest payments, just the interest, than it spent on its entire defense budget. Not weapons, not wars, not soldiers, just the cost of borrowing. Bond traders noticed that, and they didn't react the way you'd expect.
Here's what most people think is happening.
They think the bond market is reacting to the jobs report, or inflation numbers, or whatever the Fed said last Tuesday. That's the obvious read, and it's wrong. When bond traders sell long-dated government bonds, when they demand higher yields to hold them, the textbook explanation is they're worried about inflation eating their returns. That's true, sometimes. But right now, in this cycle, that's not the deep read. Right now, they're not worried about the economy, they're worried about something worse. They're worried about whether the machine that prices risk, the machine that has underwritten every loan, every bond, every mortgage in the modern world, still works the way it used to. And if you're a manager, a department head, a business owner, that question affects every financial decision your organization makes, whether you know it or not. Let me tell you about a conversation that happened in a Tokyo conference room in 1998. A senior risk officer at a large Japanese bank, let's call him Kenji, was sitting across from a team of American advisors who had flown in to explain what was happening to Japanese government bonds. Japan's economy was, on paper, functional. Companies were operating, people had jobs. The numbers looked, from a distance, okay. But the bond market was sending a different signal. Yields were doing something strange, not spiking with panic, not collapsing in a crash, just drifting. Quietly, persistently, in a direction that made no rational sense if you trusted the official data. Kenji asked the American team, "What does it mean when the bond market stops believing the numbers?" The lead advisor said, "It means the bond market has stopped pricing the economy. It started pricing the credibility of the people who report the economy." Kenji sat back. That was a different problem entirely. You can fix an economy. You can't quickly fix a credibility crisis in the machine that everyone agreed to trust. Japan's lost decade wasn't called lost because the factories stopped. They didn't. It was called lost because for 10 years, the system that was supposed to allocate credit, to decide which businesses deserve to grow and which ones should shrink, stopped working accurately. Banks kept lending to companies that should have failed. Companies that should have grown couldn't access capital. The pricing machine was broken. And because it was broken slowly, not dramatically, almost nobody caught the moment it happened. Ray Dalio spent years studying that period. His conclusion was not that Japan made bad policy decisions. His conclusion was that Japan experienced what he calls a credibility cliff, the moment when the institutions responsible for pricing risk lose the market's trust faster than those institutions can respond. Once that happens, the normal levers don't work the same way. You cut rates, the market doesn't respond the way the textbook says. You announce stimulus, bond traders shrug. Because the problem is no longer the data. The problem is whether anyone believes the people interpreting the data. Now, here is the uncomfortable parallel. The United States government in 2024 crossed a number that Dalio has flagged as a structural warning signal for 30 years. The point where interest payments on existing debt exceed defense spending. When that happens, the government is no longer primarily a productive machine. It becomes primarily a debt servicing machine. And bond traders, who price that reality for a living, noticed first. Dalio's debt cycle framework, which he developed over 40 years of managing money for institutions and governments, makes a distinction most financial analysis ignores. It separates the short-term debt cycle from the long-term debt cycle, and the difference matters enormously for what you do next. The short-term cycle is what you read about in the news, 6 to 8 years. Expansion, peak, contraction, recovery. The Fed raises rates, credit slows, recession, cut rates, credit expands again. You've seen this cycle multiple times in your career. The long-term cycle is different. It lasts 70 to 100 years, and the problem with long-term cycles is that most people alive today have never lived through the end of one, which means the psychology and the institutions built around managing it are optimized for mid-cycle conditions, not for what happens at the edge. Here is what happens at the edge of a long-term debt cycle. Debt levels grow faster than income, not suddenly, gradually, over decades, until the point where servicing that debt consumes a structural portion of productive output. When that happens, and this is the Dalio insight that most people miss, the central bank faces what he calls a push-on-a-string problem. Imagine trying to move a heavy object with a string. You can pull it toward you, you cannot push it away from you. The string has no compression strength. In monetary policy, you can tighten credit by raising rates. That works. You can pull. But in a late-cycle debt environment, you cannot stimulate by lowering rates, because the debt is already so large that new borrowing doesn't produce the same economic activity it once did. The string goes slack. The push doesn't move anything. That is the condition the bond market is currently pricing. Not a recession, a structural shift in how much the levers work.
Let's put specific numbers to this.
In fiscal year 2024, U.S. interest payments hit approximately $882 billion. Defense spending was approximately $858 billion. For the first time in modern American history, debt service exceeded national defense expenditure. Howard Marks, who manages Oaktree Capital and has navigated more credit cycles than almost any active investor, describes this moment using what he calls the sentiment pendulum. His observation: markets don't move between good and bad. They move between too optimistic and too pessimistic, and the pendulum always overshoots in both directions. Right now, the sentiment pendulum on U.S. government bonds is moving from a decades-long position of unshakable reserve currency trust towards something more like measured skepticism. Not panic, not a sell-everything signal, measured skepticism. Marx would say, this is the phase where the asymmetry of risk changes. When something has been trusted implicitly for 40 years, the first meaningful wobble in trust doesn't show up as a collapse. It shows up as a gradual demand for more compensation, higher yields, to hold the same asset at the same risk level. Which is precisely what we're seeing. Here is the supply chain parallel that most financial coverage misses entirely. Yossi Sheffi at MIT, one of the world's leading supply chain resilience researchers, has a framework called the disruption quadrant. He maps risks on two axes: frequency and impact. Low frequency, high impact events, the ones nobody prepares for because they're rare, are the most dangerous category. Not because the individual event is unpredictable, because the institutional response has atrophied from lack of practice. The end of a long-term debt cycle is a low-frequency, high-impact event. Almost no one managing organizations today has institutional memory for navigating one. That gap between the scale of the event and the depth of the institutional response is exactly what Sheffy would call a Category 4 risk.
So let's close the loop we opened at the beginning.
When a bond trader sells long-dated government bonds in this environment, they are not making a bet against the economy. They are making a bet that the machine responsible for pricing risk, the machine built on decades of institutional credibility, has entered a new phase. A phase where the rules that worked reliably for 30 years work less reliably now. Not broken, not collapsing. Less reliably. That is a structurally different problem from a recession. Recessions are weather. They pass. You prepare, you endure, you recover. A credibility shift in the pricing machine is more like a change in climate. It doesn't pass. It changes the baseline that everything else is measured against. And the organizations that thrive in a climate change are not the ones that wait for it to end. They're the ones that recalibrate.
Here is the pattern that matters.
For every professional in this room, whether you're running a supply chain, managing a team, or deciding where to allocate capital this year. The bond market is not the only system right now that is experiencing a credibility transition. It is the most visible one. Think about what Yossi Sheffi would call the supply chain parallel. For 20 years, the logic of global supply chains was built on a single assumption: that credit was cheap, containers moved freely, and just-in-time delivery was the optimal system. That assumption was not wrong. It was optimized for the conditions that existed. The conditions are changing. When the cost of capital changes structurally, not cyclically, the economics of holding inventory shifts. Holding inventory costs money. That money is borrowed. Borrowed money now costs more, not just today, but structurally for the foreseeable horizon. Which means lean inventory models that worked beautifully at 2% rates are under real pressure at 5% rates, especially when the market is pricing in that rates may not return to 2% in your operational planning window. Martin Christopher at Cranfield, who spent 30 years studying Lean-Agile supply chain design, would describe this as a Lean-Agile mismatch. The supply chain was designed for one set of financial conditions. It is now operating in a different set. The mismatch doesn't cause immediate failure. It creates accumulated friction, decision by decision, quarter by quarter, until the friction compounds into something that looks like a sudden problem, but wasn't sudden at all. Ray Dalio has a term for this accumulation process. He calls it the slow build before the fast unwind. The machine works, looks fine, handles each individual shock, until one shock arrives when the accumulated friction is already at the limit. Then it doesn't look slow at all. In Japan in 1998, Kenji, the risk officer, understood this. The bond market had quietly told him 18 months earlier that the credibility machine was under stress. The organizations that heard that signal and adjusted their financing structures, their inventory postures, their capital allocation 18 months before the fast unwind survived intact. The ones that waited for the moment to look dramatic paid a different price.
So here is what this means for the meeting you're walking into on Monday.
If your organization is operating on financial assumptions built during the 2010 to 2021 rate environment, if your supply chain design, your inventory model, your working capital ratio was calibrated for cheap money, then you are managing a lean-agile mismatch right now. You may not feel it yet. That's the nature of accumulated friction. The Monday morning action is this. Pull one number. The weighted average cost of capital your organization is currently using for investment decisions. Check when it was last updated. If it was set before 2022, it is almost certainly not reflecting the structural rate environment the bond market is already pricing. That single number, the cost of capital, is the lens through which every inventory decision, every capacity decision, every make versus buy decision gets made. If that lens is calibrated for a world that no longer exists, every decision downstream of it carries a hidden error. The bond traders noticed the credibility shift 18 months ago. This is your 18 months. If you want the full 3-framework diagnostic for running a cost of capital audit on your supply chain, Dalio, Sheffy, and Christopher together, that is in the description below. And next week, we're going to look at the aluminum shock through the same lens, because the commodity market is sending a signal that is even less understood than the bond market. I'll see you there.